I believe we're good to go. Good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. My name is Damaris Mukulu, the Marketing Manager at Genghis Capital. Today is March 29th, the final week of Q1 of 2021, and with the COVID-19 measures... I believe we're good to go. Good morning, everyone. So sorry about that. So sorry. As I was saying, with the COVID-19 measures instituted by the President on Friday, I'm certain we have plenty of questions for our panel of experts. We'll be covering the macroeconomic outlook and fixed income markets in Kenya, thanks to Churchill, who's the head of research at Genghis Capital. He'll also be taking us through the equities markets. We'll then move on to the global financial markets, thanks to Matthew Kabira of FX Pesa, EGM Securities. And maybe we can even ask Matthew if the Evergreen ship, which is stuck in the Suez Canal, has had any effect on the global commodities beyond providing us with endless memes. As always, our webinars are interactive and we encourage you to send in your questions using the Q&A section in Zoom. We'll tackle them at the end of the session. Now, before I hand over to Churchill, I'd just like to say that this would be the final session for the next 2 weeks. We'll be back in April 12th, that is after Easter Monday. So please be sure to check out our social media pages just for a reminder on when the sessions are live. So over to you, Churchill.
Thanks, Damaris. Good morning to all our participants. And to Damaris, now that our paths will not cross in the later part of this week in the office, happy Fool's Day in advance. So let me just kick it off with our presentation. Hope you can see my screen.
Yes, we can.
Okay. Let me put my video on. Okay, so I'll walk you through the macro fixed income and also equities. My colleague Kevin will not be able to join us today. So let me start with the macro calendar. This week, we expect it's a bit heavy on our end. We expect that today the CBK Monetary Policy Committee will meet for its central bank rate decision. We expect that it will be maintained at 7%. That will be like the 7th straight sitting that we are seeing that benchmark rate is retained at 7%. We are seeing that mainly due to the uncertain and uneven recovery. Looking at some of the indicators that has come out, we've seen inflation has been on an increase. We've seen that the Purchasing Managers Index, which is just telling us the pulse of the private sector business sentiment, has slowed down. That was as of February. So all this is pointing to an economy that is still struggling to pick up from COVID-19. And that's also being seen from the core inflation numbers, which has been stubbornly below 3% level. And that said, the bright spot is that private sector credit growth has picked up significantly. We've seen it touching a 55-month high of 9.3%. That was in January, just showing that at least there's some pickup in activity. But nonetheless, growth is still uneven, and the presidential address that came out on Friday just threw monkey wrench into this whole growth story. So I expect that in the near term, growth will still not be even. And that points now to the MPC decision that we'll be seeing today. Basically, we are saying that it will be maintained at 7%. On Wednesday, we expect that the March inflation rate numbers will be out. The prior numbers was 5.78%. You know that over the last one month, we've seen that the EPRA, Energy, Petroleum and Regulatory Authority, coming in with some increases in the fuel pump prices, and that's a negative on fuel inflation, and subsequently it has a knock-on effect on the core inflation. So expect that the print that will be announced on Wednesday will be a higher number than the prior 5.78%. Lastly, I almost forgot, this is something that will warm Damaris and also the whole marketing team's hearts, is that the National Treasury is revamping its website, and it will be launching the revamped website on Wednesday. So that's something that I know Damaris will keep an eye on.
I certainly will.
Of course. I know you've been complaining ad infinitum about this fact that the Treasury website needs to be revamped. So your dreams are valid. So getting on to the fixed income side, we are seeing that the secondary market activity last week, I jumped by 6.1% to a total turnover of 11.5 billion. The trades were majorly on the infrastructure bonds, the IFBs, and also the reopened the March 20-year bond paper that was reopened last month. On the T-bills segment, you are seeing that the performance was 95.7%. CBK sought 24 billion at the weekly auction. It received 23 billion, so that represented 95% performance rate. Yields edged up across all the tenors, up by 0.52% on a year-to-date basis. And from the lows of July, we've seen that it's gone up by 1.47%. That's across the T-bills segment. So we've been seeing that gradually yields have been going up. So looking at some of the liquidity trends for last week, average interbank rate went up by 0.21% to 5.21. Actually, it's supposed to be 5.61%, not 5.21%. Apologies about this. Just telling us some liquidity tightness in the banking sector and also the interbank market. In terms of the open market operations, that's the OMO, CBK was biased towards mop-ups. That was on two occasions, on Monday and also on Friday. In between, they stayed out of the open market operations. So cumulatively, they sought 15 billion. They received bids and accepted bids totaling 6.9 billion, a weighted average rate of 6.38%. In terms of net domestic borrowing, we are in our estimates, we are saying that we are sitting at 341 billion. That's inclusive of the CBK overdraft facility. And just looking at the numbers, in terms of the overall target in the current financial year ending June 30th, we are at 63.1%. And that obviously, in our view, even speaks to the infrastructure bond issue that was announced at the tail end of last week. More of that in subsequent slides. So moving on to, the infrastructure bond issue that was announced on Friday session. CBK is seeking 50 billion. The tenor is 18 years. 18 years, but then the weighted average life of that is 13.5 years. With the infrastructure bond, for some of you who may not be in the know, is that it's an amortized. So you find that if it's a tenor of 18 years, you find that say 50% of that is redeemed in between the year. So for the in between the life of the bond. So for this specific infrastructure bond, which is an 18-year bond, at the 9th year, the 50% of redemption is done, and then the other 50% is upon maturity. So that's where the weighted average life is coming to 13.5%, 13.5 years rather. And we're seeing that the sale period started last week on Friday and is running up until Tuesday after Easter Monday. The coupon rate will be market determined. This is also the similar play that happened in the January infrastructure bond, which was market determined. All along, we've been seeing that the coupon rate is predetermined by the central bank, but right now we are seeing that the coupon rate will be market determined. So moving on to the VIX trade, in light of this new IFB issuance, we are seeing a sell on. We are recommending, or we are proposing for investors to sell the infrastructure bond that was issued in January. So that's the IFB1 2021-16. So the rationale for this trade is we've seen that the average accepted rate for this January infrastructure bond was 12.257%. And right now the yield is at 11.76%. And we know that there's that inverse relationship between yields and the coupon rate. So let me take a step back. Because this January infrastructure bond was market determined, so even the coupon rate was the level that was the the CBK accepted rate. That's the 12.257%. So for an investor who put in an uncompetitive bid, so ideally your yield was 12.257%, which was the accepted average bids, and which was also the same level as the coupon rate. But right now we've seen that the yield has gone down to 11.76%. And because of that, where the coupon is 12.257% and the yield is at 11.76%, already you have made some material gains in the last 2 months that this bond has been running. So as a strategy, perhaps you can partially exit from that, recognize that appreciation that you've made. Obviously, you've not even received the coupon, which will be 6.1%, which ideally should be paid in July. But perhaps you can just lock down that gain, and then you can seek opportunity into this IFB 2021-18 paper that is coming, that is on the ongoing sale. The rationale is we are saying that most likely because if a 16-year infrastructure bond paper had a coupon rate of 12.257%, there's a higher likelihood that even the coupon rate for the 18-year paper will be higher than that. So you're saying just, we haven't, we're still finalizing a note on this, but you're seeing upwards of 12.4% up until 12.65%. And that's the yield. So it's just getting into at a lower level, a yield which is higher, which means that you'll be getting at par, but then gradually this paper will obviously come to where the current yields are, and then you can ride the wave. It's something that you can look at, and or if you have a January infrastructure bond paper, alternatively you can just enter the 18-year infrastructure bond paper that is currently on sale, even without even following a recommendation. But this is just an idea that some of the investors might be able to think about. So that's it about fixed income. So let me just get into the equity side. Looking at last week, we saw that the NASI dropped by 0.3%, while the NSE 20 share index dropped by 1.6% week on week. All this turnover went up by 18.6% to 2.4 billion. Top gainers, HF Group gaining 34% last week. I think this was majorly because of the announcement that came out that Britam will be offloading its stake on HF. So that is the announcement that propelled HF to the top gainer last week, gaining 34%. Samia gained 11% and Sasini gained 9% last week. So that closes the podium finish of the top gainers last week. Top losers, Diamond Trust Bank declining 9.8%. Diamond Trust Bank released its earnings for full year 20, announcing the drop in EPS, earnings per share, by 52% year-on-year basis. So that's the proximate cause for the drop of Diamond Trust Bank. NCBA also dropped 7.4%. Coincidentally, NCBA has released its full year numbers today. We've seen that it has announced a 63% drop in earnings per share, but it has offset it with a dividend per share of 1 shilling and 50 cents. That's something that has come out of just in the headline numbers. We haven't even drilled down to see the growth factors of NCBA. But that's it. It has announced its full year 20 numbers. And Liberty also declining 6% last week. So that is rounding the top 3 losers over the course of last week. Moving into the foreign participants, we've seen that the participation by foreigners was at 48.7%. I remember a couple of weeks when we're talking about the foreign participants, we are seeing that they were taking the lion's share of the market activity. But I think this is the second consecutive week running that we've seen that the foreign participation is below 50%. But nonetheless, the net inflows last week was jumped think it was 10 times what was there the previous week. Net inflows of 488.4 million. Foreigners accumulated on all the four blue chip stocks, that Safaricom, KCB, Equity, and EABL, and those were the top 5 traded counters, inclusive of Stanbic. Moving on to where the Kenyan market sits against the sub-Saharan African peers, we are seeing that the market, the price to earnings, this is where the index is, as a percentage or as a multiple of its earnings, whereby Kenya is at 12.5 times. So for every a shilling that you get in terms of the net income through the NSE All Share Index, the price is 12.5 times that. But if you look at where the African average is, it's 9.6 times that. So that is telling us that with this metric, price to earnings, Kenya is a bit overvalued based on that metric alone. And looking at the dividend yield, a dividend yield of 2.3% against an African average of 4.7%. So the dividend yield is below the typical sub-Saharan African market that we track. So that also is another negative sentiment. Nonetheless, investors are choosing stocks selectively, and that's also what has been propelling the market, or even by the foreign side, as who are looking into the Kenya, they are quite selective of the stocks despite the overall market's negative sentiments. So moving on to corporate calendar, cooperative final dividend of a shilling. The book closure is this Wednesday. BAT Kenya, final dividend for 41 shillings and 50 cents. Book closure is on the 16th of April. KCB Group, a shilling, final dividend, book closure on the 26th of April. Stanchart last week announced a 10 shillings 50 cents final dividend. The book closure is on the 27th of April. Kengen, 30 cents final dividend, book closure on the 29th of April. Stanbic Holdings, 3 shillings 80 cents final dividend, book closure on the 21st of May. We also have a few names that announced last week. Kakuzi, rather that was the previous week. Kakuzi, 18 shillings final dividend, 31st of May. NSE, 53 cents announced last week, 4th of June. And finally, Omeme, 12 Uganda shillings final dividend, 25th of June. And I know NCB has announced 1 shilling 50 cents. I will also update you on the book closure once you've been able to look deeply into those numbers. Getting on to the week's trade. We are still sticking to long-term trades on those stocks that have that have strong buffers to weather the storm. What we saw on Friday is that COVID-19 and the shock, and also the negative impact or the negative spillover from the tighter containment measures might have even on the listed names. So as a strategy is for investors to look at those names that have strong buffers so that they can be able to weather this storm. So that's one of the rule of thumbs that we are putting out. The other one is now buy on Stanchart. Stanchart sits in our Genghis income model portfolio. It accounts for 13.4%, and traditionally how it ended up in this portfolio is because it has been giving decent dividends, and that we were vindicated even with the announcement that came out last week, issuing a dividend of 10 shillings and 50 cents. And that represents a dividend yield against the current price, Stanchard's price, a dividend yield of 7.2%. And if you compare with the banking sector average right now, which has a average dividend yield of 3.8%, Stanchart is quite attractive. So that's a trading idea for our income-oriented investors. We have an out of consensus trade And what do you mean an out of consensus trade? I know that based on the containment measures that were announced by the president, one came out sticking like a sore thumb is now the suspension of bar operations in the 5 infested counties: Nairobi, Kiambu, Machakos, Kajiado, and also Nakuru. And we have EABL, which is sitting in our Momentum portfolio, whereby we also have this target price. I know that right now, perhaps the morning notes that you may read with other investment banks or the sentiment that is coming out is that perhaps EABL's price will come down. Of course, it goes without saying, just if we look back at the impact of the containment measures that were there in the second quarter of last year, that's a cautionary tale. Looking at the volumes, second half of last year, basically between the second half period, dropped by 28%. But that was just because of one quarter. So you find that if it, for second half period, this is between January to June, dropping by 28%. But that's just an impact of one quarter. It's just telling you how the volumes impacted the growth. And looking at the full year numbers, this is for EABL full year between July 2019 up until June last year. The earnings dipped by profit after tax dipped by 39%, and that's just an impact of one quarter. So based on that, I'm sure that what we'll be seeing out there is this negative impact on EABL in the short term, just because of the closure of bars in these 5 urban dominated counties rather. It's not countrywide, but it's just 5. Of course, we know that the volumes for EABL, significant chunk of that, I think 69% comes from Kenya, but now a closure of 5 counties will have a dip on volumes even going forward, and also the earnings. So that's the context of this out of consensus trade. So rather than perhaps selling your EABL stake right now, you might hold it because they might, right now it's still open-ended. We don't know whether these containment measures will be with us for 1 month, 2 months, 3 months. From the statement by the president, it was a bit open-ended. So that's the other uncertainty. But rather than now selling right now, perhaps you may now consider getting into trades, into derivatives. So that's the out of consensus trade. So assuming that you have 1,000 EABL shares, close of last week, it was 167.75. So investment right now is 167,750 shillings, right? So for EABL, now the thing with the derivative, for those counters or those equity contracts which has a price above 100 shillings, one derivative contract equals 100 underlying shares. So here in our example, we are using 10 contracts. So 10 contracts will be equivalent to 1,000 underlying shares, which is similar to what you have right now. So what you need to do as an investor is now to deposit an initial margin of 2,300, and then times for every contract, so that comes to 23,000, and then there's an additional margin which is 10% of the initial margin, so another 2,300. So for you as an investor, perhaps you may invest 25,300 at least to be able to go in with this trade. So the entry price, now you're still using the prices that were there on Friday, which is 167.75 on the at the close of last week. But then on the derivatives, there's a markup to that. So the price, had you come in on Friday, it was 170 shillings and 30 cents. So we have a target price of it's actually a target price of 160 and a stop loss of 175. So in the event that the price of EABL goes down to 160, as an investor who has 1,000 shares of EABL, you lose 7,750 shillings. So that's roughly 4.6% on your EABL investment. But then on the derivative, now we are shorting it. By shorting it, we are banking, or you are expecting that the price will go lower. So with a target price of 160. So it goes from 170 shillings and 30 to 160. Of course, I've simplified, but I've ignored the premium that is there between what is there on the listed market and what is there in the derivative. But working with a target price of 160, you will realize 10,300 on your investment of 25,300, and that is a performance of 40.7%. Of course, we have, based on what I've walked you through, we have not entirely hedged the investment. For you to entirely hedge the investment, because based on the underlying shares, so it will mean for you to have an equivalent investment of 167,750 in the derivatives. That means you'll have to buy 66 contracts so as to have some perfect hedge on that. But for simplicity's sake, I've just stuck out at 10 contracts here. So you find that as the price goes down to 160, on the shares, you lose 7,750 shillings, but then on the derivatives, you gain 10,300, and then it has a net effect of a gain. So that's the out of consensus trade that we had for this week. So let me stop it here and invite Matthew to walk us the global markets. Matthew.
Good morning, everyone. Let me share my screen. So there we are. Hope you can see my screen clearly. So let's check out on the opportunities we have in the global markets, what happened last week, and what we're looking forward to this week. Last week, calendar has been quite busy, and we're looking up to see what was going to happen on the gold and Swiss National Bank fixes. So US shares rose amid lower than expected jobless claims and the Fed's announcement regarding holding its policy, and the EURUSD pair dropped, of course, its lowest level since November, and oil dropped for the second week in a row. Gold traded in a range with a capped upside, a strong US dollar, and as I said, the Swiss National Bank increased its rate, and the traders ignored better than what we were looking for last week. UK, Euro, the PMIs really came up better than expected, but they didn't move the market as much because, of course, that's what we had for last week. So this week, looking ahead, we for the US, yeah, that's data from the labor market in the US, and of course, looking at the previous, we had an expected strong.
Matthew, hi. Matthew, I think we're having an issue with your audio every time you turn. Churchill, is it the same on your side?
Yes, I confirm it's the same on my side.
Yeah.
Is it better?
For some reason, when you look in the direction you're looking at now, the audio is better.
So, well, let me see what I can do about it. I think the connection is a little bit. How about that? Is it better now?
Yes, it is.
Okay.
Thank you.
Yeah, let's proceed. Let's proceed. Thank you for notifying me. So I was talking about the event, the main event that we're looking forward to this week, and it's the NFP on Friday. That's about it. And looking at the numbers we had on February, we had unexpectedly strong surge in employment at 379,000 new jobs, and the unemployment rate. Of course, the vaccine rollout is supporting the US dollar. Of course, they have a very strong strategy and it's really working for them better than on the European side or any other part of the world. And then the 1.9 trillion stimulus, it has lifted the business confidence, and that one is likely to raise the numbers in March. So the expectations of the market are a little bit positive, but we have to keep watch on the NFP numbers this Friday. Now, on the calendar again, of course, we have some other news lined up. It's very important. You check out on the UK money supply, important there. On a Tuesday, CPIs. Of course, we have the ADP and farm. Okay, Canada GDP for the Canadian dollar. On Thursday, we have the JMCC, OPEC JMCC meetings. Those ones are likely to affect the oil. Of course, we've been having the blockage of the Suez Canal. That one has an effect on the transportation of oil, right? So on Thursday, we want to hear what the JMCC and the OPEC are going to say. Of course, we're looking forward to see with the oil cost will remain. Of course, we have fresh new situations right now because economies are locking down again because of the spreading of the coronavirus. So these are the key events you should watch out as you're trading on the relevant or the related. Very important, the non-farm payrolls on Friday. Very, very key. The movement of the now EURUSD, and this is amid, of course, concerns on the European side, where we're having fresh lockdowns there and a little bit of worsening situation with the COVID-19 and the distribution of vaccine not very well as compared to. Traders will be monitoring any vaccine area, of course, is pale compared to that of the US, and of course the renewed lockdowns amid third wave of the coronavirus. Now, looking at EURUSD technical levels, you can see we're on a downtrend, and currently the price is around 1.17781. As at the time I took this caption of the charts, it was around 1.17. The technical levels we're watching out for is whether this price is going to break below the 1.17400, right? Because of course we see that the prices are below the moving averages, right? So whenever the prices are below the moving averages, it favors a downward move. So we had a small small pullback here as regards to that downtrend. But again, currently we see there's some selling pressure, of course, with the weak European side and a strengthening dollar, because again, the dollar index is keeping on rising, is strong even now. So we need to watch whether the pair will break below the 1.17400. That's what will guarantee, or what will give the traders and support to keep on going to short positions. And again, you have to watch out and see whether it will breach the 1.18500 level all the way to test the downtrend. And if it breaks above the 1.19 19 level, which is a great psychological level, which the traders are watching outside there. That's when we might get good opportunities to buy. That's for the Euro USD. So moving on next to USD Canadian, of course, the same factors for the US dollar, but remember, Canadian dollar is like a commodity currency because it is very much related with the oil, right? So for the USD Canadian, of course, we want to look at the developments around oil, because when you check out on the movement of the USD card and the movement of the oil, it's like they are inverse, right? They are inverse. So currently, when you check out on the charts, realize that it's trading below the moving average, especially the 200 moving average on 4 hours, and still on a downtrend. USD card is on a downtrend. So currently, we want to wait and see whether this price will break that. There's a small range there. If it breaks above that 200 moving average, and then of course we have to wait and see whether it breaches the 1.267 level for traders to try catch some opportunities on the upside. And on the flip side, of course, if we have the oil, of course, gaining some more traction, of course, we have the Canadian dollar strengthening, of course, and that might keep this one on pressure. And if it goes below the 1.2500 levels, then of course, traders might find opportunities to short the markets, looking all the way to the levels of 1.24, 241 around there, or 23, the lows of March. That's on the two products to watch. And now delving onto the stock side, of course, companies' earnings reports to watch out for: BioNTech and Chewy, Micron, Fair. And then for the companies, based on the dividends announcements, we have the Dairy and Company, American Express Company. Those was there, Aichawi Unibanco, Tail and Wimper. That's what I have for this week. Looking forward to hear your questions. Over to you, Damaris.
Thank you so much, Matthew. I like that you touched on the Suez Canal, because I don't know, I had concerns myself. So thanks for your presentation. And Churchill, thank you for macroeconomic, fixed income, and equities. So we do have a couple of questions, and I'm going to just dive straight into them. So Churchill, this new infrastructure bond is creating a lot of buzz, both here and on our social media platforms. So we have George Ndagwa who's asking, what rate would you recommend we bid for the IFB? And how can one place multiple bids to ensure you get the best price when you're investing about 4 million shillings?
Thanks for the question. So for 4 million, anything below 20 million, an investor can put in a non-competitive bid. So that means that for you to get access, or for you to be sure, it's like a sure bet, for you to be sure that you'll get access into that IFB. So for a non-competitive bid, you'll just get the bid at the weighted average of the bids that will be placed. But having said that, that's a good question that I think it's George has put out. So how do you go about it? So our thought process, we are saying that the IFB 2020-16, its coupon rate or its yield was that when it was at the auction was 12.25%, and that was the coupon that was issued. So, and we're saying that here there's an 18-year infrastructure bond. So we're saying that because of the higher maturity as compared to the January bond, we're saying that most likely the coupon rate will be higher than what was there in January. So we're saying north of 12.4% up until 12.65%. Thereabout is what, that's where the likelihood that the bond will, the weighted average rate of the bond will fall into. So you may stagger your bid, be it 4 million, you may stagger, say, 1 million or 2 million of that, put it at 12.4%, another 2 million, put it at 12.5%. This just hypothetically, or you can just put one rate for the 4 million. But for you to get into the bond, because it's falling below 20 million, it's good just to get into the competitive bid if you're not sure of the yield to bid as an investor.
Thank you so much, Churchill. And to George and anyone else who's interested in the IFB and has similar questions, you can reach out to our team on info@genghis-capital.com, and our fixed income desk will be more than happy to walk you through the process. So I have a question here from, I think this is for Matthew. So a question from Felix. I don't know if this is Felix who also gave you a tip to hold your jack pen, Matthew. So Felix is asking, as we await the OPEC meeting on Thursday, kindly briefly address on the most probable outcomes the Evergreen blockage will have on the commodities, futures, and forwards. So someone else who's interested in the developments at the Suez Canal. Over to you, Matthew.
All right, good question there. And of course, that blockage as like frozen a little bit, held up on the supply chain, especially to the movement of goods between from the European side, of course, coming all the way even to Africa and even the Asian side, because that canal is really very important. It has led to the ships going all around the African, of course, the South African end. And of course, that's what it means for oil is that when that part is blocked, remember, on a daily basis, there's up to around 100 million barrels. Thereabouts, not quite sure, but quite a large amount of oil or crude oil is transported along that region. What it means is that it's freezing out or trying to reduce to cut on the supply. And when the supply is choked, if the supply is choked, then that one tends to beat the oil prices a little bit higher, right? So even with that lower, with that affect the effect of the supply of oil there, of course, we have a reduction in the demand of that oil or the consumption because of the fresh lockdowns in the Europe. So that is the effect we have on that blockade on the Suez Canal. But of course, it's like that ship has already been refloated, and maybe within a very short time, I don't know whether 3 or 2 days, although I can't speak authoritatively on that, we have to watch out the news. If it gets better, then of course we're going to see that debacle off. But waiting up to the information on the JMCC and the OPEC meeting, we want to see whether they are going to what they're going to do based on the supply of the oil, distribution of the oil, and the production and consumption. Because again, on March, what happened is that all the oil-producing countries decided again to keep the distribution and production cuts as they were. So we want to see whether how they're going to reconsider that one again, of course, and if they are going to maintain the cuts, because I'm seeing they're likely to maintain the cuts because they can't keep on pumping the supply when the consumption has not really gotten up with the effect of coronavirus. So we really have to wait and see how they're going to react, because again, we have a mix of options now with the fresh lockdowns and the effect of coronavirus.
Okay, thank you so much for that, Matthew. I have a question from Cliff Mayaka. NSC versus African peers. I believe this is a slide in your presentation, Churchill. Cliff thinks that you should also consider South Africa, which accounts for significant market capitalization. So would you comment on that?
What we have in the slide for Kenya vis-a-vis select sub-Saharan African peers is at least those who are more seen as our peers. South Africa is a bit more advanced. It's a liquid market. It's seen as an emerging market. Same line with Nigeria, which we also cover, but in terms of the bosses, the comparison that you put, we tend to see them as peer comparison. But that's a good suggestion from Cliff that you might put into consideration even going forward in terms of our analysis of the whole broader sub-Saharan African space.
Okay, so we expect to see that in one of our future webinars. Thanks, Churchill. Kamal has a question that's been upvoted by several of our attendees. Kamal is asking two things. First is, why are foreign investors cashing out of Safaricom, yet the verdict on its entry into Ethiopia is next month? And secondly, lockdowns, referendum, elections all affect the equities market. Besides Safaricom, which are other shock-proof counters? So he wants to know where to put his money in this current environment.
Those are good questions. So the first part of the question, which is addressing foreign activity and mainly on Safaricom, and looking at our statistics that we even put out earlier on, is the fact that last week we saw 418 million in terms of net inflows by foreigners, which was 10 times what was there previously. And specifically for Safaricom, we saw that investors had a net inflow position into the stock over the course of last week. It closed at 38 shillings 75 cents. So there's a bit of some positive price action. That was a positive price action over the course of last week. Of course, we are 50 cents flirting with the record high 39 shillings 25 cents that you've seen on the counter. But nonetheless, at current levels, we're seeing that there's still some positive vibe. The issue about Ethiopia, the license, and Safaricom bidding into that, we're likely to see it coming out early next week, because that's when the deadline will be out, and that's also will be another, will either propel positive sentiment in the stock in the event that Safaricom gets the license, or a negative sentiment in the event that there's still some headwinds in regards to the license. So that's something that even is still up in the cloud. It hasn't been fully digested, but once the news is out is what will also dictate the price of Safaricom as we head into its earnings results. It will be releasing its full year numbers. That's late April, early May, thereabouts. So that's the other news event that investors will be looking at. Getting on to right now, the second point of the question, the second part of the question, talking about all these negative headwinds. There's a referendum, there's COVID-19. Yes, there are some stocks that we see are still robust, but those are the blue chip stocks that most investors have on their portfolios already. We're talking about Safaricom, we're talking about the banks, that's Equity, KCB, and partly we're seeing EABL. So at least those ones, in as much as there's these negative sentiments, they are seen quote unquote as defensive, or they are those momentum stocks that investors can be able to come in, get out with time. So that's what's sticking out in our portfolios. Of course, even across the different sectors, we can get hold on to some of those stocks that have big buffers to weather the storm. So that's also for the investors to keep an eye on. But top of our list are those four blue chip counters for investors to keep an eye on. So back to you, Damaris.
Thank you so much. So Kamau, it's the blue chip counters that we can keep our eye on during this, what's the term, Churchill, you called it, this stimulus time? Anyway. No, there was a specific term you used to just cover this lockdown, referendum, elections.
Headwind.
Yes.
Yes,
negative
headwind. Like you see the way you are traveling in an aeroplane, and then it's good for as a pilot navigates up there, and then headwinds are those winds that tends to slow down the plane, and then tailwinds tend to propel it higher. So that's where the terminology comes from. So headwinds slows down, tailwinds bring it up.
Who said research was boring with such metaphors, man? Thank you so much, Churchill. So I want to go to Bernard's question. He's like, will the huge borrowing by the government affect the riskiness of the investments in bonds, for example, the IFP? So I like his question because the IFP is attractive, but does the huge borrowing by the government, which you keep hearing about, does it negatively impact investing in bonds?
Well, that's a great question, and it's something that we we also are mindful of what the risk of giving money to the government. Broadly, or the rule of thumb is that lending to the government is seen as a riskless venture unless this Armageddon risk that the Republic will go bananas and then they are not able to refund back our money. So that's it's called an outlier risk, or it's a black swan, or it's a tail risk. All these are jargons for the risk of now the government not being able to default. But looking at the sequence of things, you know that the government borrows both externally from foreigners and then borrows domestically. So that split is around 53% or 52% from external sources, and then the other 47 or 48% borrowed locally. The main risk with the government is for it, if that sequence of default starts, it has to default on the external first and foremost, because that debt is domiciled in a different currency, so it's much easier for it to default on a non-Kenya denominated debt as a first place before it even defaults in the local debt. So at the moment, of course, that fiscal deficit has been on an increase. There are those indicators that are telling us that we are just closer to that limit of distress. But having said that, rule of thumb, just looking at where the foreign exchange reserves is, I think is at 5.7, is it 7.5, $5.4 billion thereabout on reserves. And then the short-term debt, of course, there's that DSSI debt service suspension initiative that Kenya received. So that means that even in terms of the short-term debt to be serviced in the next 6 months, 1 month, looking at it, I think is around 300 billion shillings, and then compared to 540 billion. Even if we use the reserves that we have at the central bank, we can still service that debt, even without factoring in some of the inflows that are expected to come in. So that's the worst case scenario. So even before we come to the domestic debt, it's still a long haul. So the first line of defense, if I may say it this way, is now, or the first offensive or the first red flag is if we are not able to service the external debt, and that even magnifies the risk of us, the government not able to service the local debt. So far, we are still not yet there, despite the fact that there are still some alarming bells that we are closer to there. So let me just stop it at this point. I hope I've answered the question.
You have. I think, Bernard, and to the rest of us, it's pretty clear that we're a long ways off from being worried about investing in our bonds, and that it still remains one of the low-risk investment options. So thanks, Churchill. I just want to soldier through because I know you have a couple of questions for Matthew, and I want to get into that. That's interesting. So, Bernard again. Bernard, I see bonds are your thing. Bernard is asking, he'd like to invest in bonds in Rwanda and South Africa. What's your opinion on that?
Well, we may need to take it a bit offline. I don't have visibility on the Rwandan market. At least the South African market is liquid. You find that foreigners investing in South African bonds at some point were around 40% holders of South African rand denominated bonds. And if you compare with Kenya, foreigners account to around 1% of the local bond holdings. So it's quite small compared to what the bonds or how foreigners perceive or how liquid the South African bonds are to the foreign market. So, but outside that, unless I'll have to dig some information and then I can be able to engage Bernard much more comprehensively.
Okay, thanks. Bernard Onsongo, if you'd like to continue this conversation with Churchill and the research team, I urge you to send an email to research@genghis-capital.com, and you'll be able to have a tete-a-tete with them. The last question now is from Vincent Gakunga. He wants to go into the housing finance story. Is it worth the hype? So I know there was the bits about Britain selling its holdings in HF. Is there something you want to add to this conversation, Churchill?
Well, it's something that hit the news flow last week, that Britam is looking at offloading its stake on HF Group, and something that you've also mentioned in line with the new management. Britam has a new CEO, and he's had a few engagements with analysts in the industry. And one of the things that he pointed out is now the Britam investments now holding into this, what I may say, the legacy equity investments. That's on Equity Bank and also on HF Group. And that has been the major cause of fluctuations in earnings, because at the start of the year, you find that the stock is at, say, X amount, and then by the end of the year, it has eroded. So that is quite volatile on the stocks. And more so, the CEO is quite keen on looking at or having the core business of Britam, which is insurance, to be at the forefront. Right now, the board of Britam is also at the process of coming up with a new 5-year plan. So I think that just coincides with the news flow item that we saw. Having said that, and I think it was touching about a big bank now coming to acquire HF Group. So that's what investors are just looking at it in positive stride. So it's purely sentiment. We still don't have the details. Britam hasn't given an official statement around it. So at the moment, it's just sentiment propelling the stock to where it was closing at 34% high, week-on-week higher.
Okay, thank you so much. So fueled by sentiment. We've come to the end of all the questions from our attendees, but Churchill, I think you had a couple of queries you wanted to flow to Matthew. So perhaps you guys could take the next 5 minutes and have this interesting discussion.
Thanks, Damaris. Could even be shorter. I'm quite, Matthew had mentioned something that the unemployment rate report for March in the US will be released this Friday, which is a Good Friday. So I'm quite amazed by that. I don't know, perhaps he didn't say it explicitly, but it's on a Good Friday. People are perhaps getting into their festivity moods and what, but it's quite interesting that they were not even able to postpone it. And I'm bringing this in line because of the fact that here locally in Kenya, we have the 4th quarter unemployment report, which have been beaming in the last 5 webinars or so that it has been delayed. This was supposed to be released in February. We're still sitting in the dark. So I don't know whether it's something we can pick from the foreign investors or from the global markets, that if data needs to be out there at a certain point, it is out there then by that certain point. So that's something that is an observation that I noted, which we are able to pick from the global markets. Anyway, a few quick questions to Matthew. This is just really quick, just to pick a brain short answers. I know the first one has been touched a lot in this webinar, but I'll just ask you 3 quick questions, short responses from my end. Quick one, the first one. This Evergreen ship, how long do you see it will be fully removed from the Suez Canal? Do you see it before Easter or after Easter? Before Easter or after Easter, Matthew?
So currently with this Evergreen ship there, currently following up the news, we see that it has already been partially refloated. So there are really quick efforts to make sure that that canal is open, because it might cause a snarl up of supply challenges there, because what it means, if it keeps on blocking that route, then of course you have a lot of problems with the movement of rare earth semiconductors, of course, from the Asian side, and that's going to cause problems with the manufacturers of cars and the others who are using the semiconductors. And all those things, again, if they're not able to pass through that canal, then it means they're going to, again, start either docking somewhere else and wait, or maybe if they cannot dock on the west side or the west coast side, then it means they are going to offload whatever they have. So they need to move with speed. As to when they're likely to open up that one, of course, we need to keep watching the news. But now that they have already partially refloated the ship, of course, we know that the Biden already offered some support there. And looking forward, maybe because from last week they're talking about maybe 3 days. So we want to wait and see whether maybe by Tuesday, Wednesday, whether they will have really sorted out that one. But we have to wait for the news from the ground.
Long and short before Easter.
Maybe not.
Okay, maybe.
In Matthew's defense, I even read an article where they're relying on the gravity pull from the full moon. So I feel like right now it's all up in the air. So let's just hope the high tides help.
Yeah, it's something we have to wait and see what really happens on the ground. But what we can see, of course, there are developments. If they are able to partially float it, then it means that maybe they want to work out on that, because again, they don't want to cause a snarl up or a bigger problem in the supply chains. There's quite a lot at stake, and there are much more efforts to try and clear out that.
Wow, so you're neutral about that in your answer from how I get it, but nonetheless, thanks for that. Now to the second round of question. We saw last weekend the president of Turkey firing his central bank governor for hiking the interest rate by 2% just to tackle inflation. I know I'm just bringing it in the context that even today our central bank monetary policy committee will be having a meet, but nonetheless, I'm not in any way alluding that there'll be anything along those lines that will happen locally. But having said that, we've been seeing this revolving door at Turkish Central Bank, whereby I think this is the third governor in 2 years or less, unless I'm wrong. So how long do you see the new governor sticking out? Do you see him sticking out in the next, in 3 months, more than 3 months or less than 3 months? More than 3 months or less than 3 months?
Okay, on the Turkish issue, I've not been quite deep on it, but of course we've seen that the Turkish lira has really taken a fall up to 15% after the governor was sacked. So I cannot speak much more authoritatively on that unless I get back to you once I get more information about that, Churchill.
Matthew, today you're dodging.
I'm not dodging, actually.
Anyway, just kidding. No, now final one. Now bringing it home. We saw the president last week announcing the tighter containment measures in these disease-infested counties. It's open-ended. We don't know how long it will be. In your view, just in your view, do you see it going more than 1 month or less than 1 month? More than 1 month or less than 1 month?
Well, this one, yeah.
You don't even need to justify.
This one might go more than 1 month.
Okay. Fair enough.
And you, Churchill, more than 1 month.
Because again, what we need to look up for, you see, sometimes when you look at these fundamentals, it's not a question of like a yes or no, or like something will actually happen or not happen. We have to keep how the infection rate keeps on piling up, or if there's going to be a containment. Currently, we have not really seen the country being up to speed with the vaccine distribution, and we want to see what's really going to be the development on that end. If they keep on going up, then of course, the president is likely to be compelled to keep on maybe even extending the lockdown to even more strict guidelines. But if thank God that it eases and improves within a month, then we're likely to see the improvement. Because what I read from the administration is that they really looking. It's in their best interest to see the economy getting on its feet and people getting back to, of course, getting more employment levels, and economy gets on its feet, and even better off moving forward to optimism in the growth of the economy. So as the question of whether we're expecting it to be maybe next 1 month or next 2 months, something again we have to watch. I have to be really cautious about that.
Okay, I want to add, although we didn't ask for Damaris's perspective on this matter, but my thoughts are probably like George's, that he'd mentioned that we're likely to see a flattening of the curve by mid-May. So I actually think it's probably for the next month or so. And George seems to have the same sentiments. But I think the most important part is let's just play our part in helping that come in sooner rather than later. And yeah, let's just wait and see. That's really all we can do. So gentlemen, does this conclude our most interesting segment of Q&A?
Quite interesting. I like it, Churchill.
Thanks, Matthew. Thanks, Damaris. At least it covers the fact that next week will not be around, and then we'll pick it up in the next quarter. That was quite interesting. Though it was neutral, but it's just highlighting the fact that there's so many moving points, be it in whatever themes that we're looking at, be it in the global markets, be it even in the local markets. There are so many moving parts, the uncertainty, but nonetheless, we wish everyone safe. We are getting into Easter, so just be safe, and looking forward to see you in the second quarter.
Awesome. Matthew, any parting words for the final quarter, for the first quarter of 2021?
Well, the first quarter of 2021, it's been one that we've been looking to get from the risk off, right, to risk on kind of a thing. But again, the markets are still recovering. We're looking forward to see whether there's likely continuation of even better sentiments on the European side, and of course, hoping the recovery in the US keeps on that way. That is going to give a general view of positive sentiments in the market, and looking forward to see how the developments get along with the coronavirus.
All right, Matthew, thank you. And thank you for being a part of Q1. We look forward to seeing you in Q2. I'm sure all our attendees are also looking forward towards the same. And I encourage you to have questions for Churchill. Just drop me an email that you have questions for him for the next session.
I will.
Awesome. So thanks everyone for joining us for this edition of the Genghis Weekly Investor Briefing. The video will be live on our YouTube channel shortly. And let's meet on April 12th, which is the next edition, the next working Monday. Have a safe and good Easter. And thanks again for joining us. Thanks, Matthew. Thanks, Churchill.
Thank you. Thank you, everyone. Happy Easter.
Okay. Bye-bye.
Thanks, everyone. Bye-bye.